Let me invite our panelists to come forward, and as they do, I will introduce them. Rajan Cohen is the senior chairman at Sullivan and Cromwell. He joined Sullivan and Cromwell in 1970 and has been at the forefront of banking, finance, and law as long as I've been involved in this. He's a member of the FDIC Systemic Risk Advisory Committee, the Board of Trustees for the United States Council of International Business, and I think of all the many descriptions of Raj that I've heard, my favorite is he is forever known as counsel to the situation. Whenever there's a situation in financial services that needs counsel, Rajan is there, and we're very grateful that he's here to provide his counsel and wisdom to us for the benefit of public policy. Rajan has also been a strong and longtime supporter of Brookings and the Economic Studies Council. Next is Karen Gifford, who I mentioned was a co-author of mine and serves as an advisor to One World Identity. She's a council member at the World Economic Forum. Previously, she worked at Ripple Lab as head of compliance. She's worked at a bunch of other financial consulting firms, but served as counsel and officer at the New York Federal Reserve Bank for almost a decade and received her JD from Yale Law. Next to Karen are a pair of Harvard guys. We'll start with Juan Zarate. Juan Zarate served as the Deputy Assistant to the President and National Security Advisor for Combating Terrorism from 2005 to 2009. He was the first Assistant Secretary of the Treasury for Terrorist Financing, Financial Crimes. When I say 9/11 changed everything, perhaps it changed nothing more than Juan's life and his work. And for that, we all owe him a great debt of gratitude in making sure that we've gone 18 years without a similar incident. Currently, he serves as chairman of the Financial Integrity Network and a senior advisor at the Center for Strategic and International Studies and is a visiting lecturer back at Harvard. Next to Juan is J.W. Verrett, who's an associate professor of law at the Scalia Law School, George Mason University. In addition to being a scholar and a gentleman on banking, securities, and corporate law, he serves on the Investor Advisory Committee at the Securities and Exchange Commission. He was chief economist and senior counsel to the U.S. House Committee on Financial Services for Chairman Jeb Hensarling. And he's also the managing shareholder of Veritas Financial Analytics, a compliance and expert witness firm. And JW is frequently able to espouse consistent and intriguing views on what securities law and banking and finance regulation mean for society. And we're really thankful that you've spending your afternoon with us. But let me start with a question for Juan, who served in the Bush administration in the White House and Treasury, as I mentioned. What's your reaction to Congresswoman Maloney's speech? Where do you think she's right? Where do you think she's wrong? And what do you think is realistic to expect in terms of change?
Well, that's great. Well, first of all, good afternoon. Thank you, Aaron, for having me here, especially on 9/11, such an important anniversary. I loved Congresswoman Maloney's speech, and I commend her for what are not just weeks and months worth of work, but years worth of work. Not to mention others in industry as well as the Treasury, my partner Chip Ponce, who for 10 years was banging his head against the wall, trying to make the argument very clearly that issues of systemic transparency and accountability and traceability that Congresswoman Maloney was talking about are fundamental to national security, not just banking regulation, not just safety and soundness of the financial system, but actually matters to understanding where money's coming from, where it's going, and whose hands it sits. And that's exactly, I think, what Congresswoman Maloney is talking about. I think there's all sorts of challenges, and I think we'll probably get into that in this panel. What's fascinating about having this discussion on 9/11 and listening to the Congresswoman is the anti-money laundering system and the sanction system, both in parallel and in dovetail, is more important now to national security than ever before, even after the 9/11 period. And the reason for that is we're demanding more of the financial and economic system to reveal the vulnerabilities of America's enemies, as well as to understand where criminality, illicit financial activity, and even rogue actors are accessing that financial system. You look at North Korea, Russian organized crime. You look at terrorist activities. There was a new enhanced executive order pronounced yesterday with respect to terrorist financing. So the list goes on and on as to how we're applying these tools. At the same time, we're having fundamental debates, and this is where there has been criticism of what Congress has been trying to do. Fundamental debates about whether or not the system is actually effective. Does the system actually do what we want it to do, which is to prevent rogue actors and suspect and criminal actors from accessing the financial system? Because one of the things we asked the system to do, in the private sector in particular, post 9/11, was to protect the system from rogue actors, to use financial tools and measures to exclude them. And ultimately, the strategy of the U.S. Treasury and the U.S. government has been, can you make it harder, costlier, and riskier for rogue actors to raise and move money around the world, to access the elements of the financial and commercial system? There's a fundamental question underway, and one that goes to the efficiency of the system as well as its effectiveness, as to whether or not the system's doing that. Can the system allow for it? And I think what Congresswoman Maloney talked about is one piece of the puzzle. We have to understand beneficial ownership if we are to be assured that we're not letting money launderers use the U.S. system in bulk and volume to hide or place their money, if we're sure the terrorist financiers or networks aren't accessing the U.S. system, if we are to be sure that Chinese front companies, Russian front companies, Venezuelan kleptocrats aren't accessing high-end real estate. So all of that matters now more than ever before, and I think what the Congresswoman laid out is one piece of the broader debate as to whether or not the system works as designed.
What else do you guys think in terms of where she was right or wrong, or is it realistic to expect that we're going to get some change?
I'll be the optimist. Apologize for my voice. I think this legislation will be enacted. It's long overdue. It's only a relatively small piece of the puzzle, but it's still a piece which needs to be put in place.
So I would jump in that I'm going to take the unpopular position on a very difficult day to take that unpopular position, that I'm actually a critic of the beneficial ownership bill as designed currently. And here's why. Let's start with this question for everyone, hypothetical. Would you be okay with FinCEN having access to your personal bank account login and credit card login information? And if the answer is no, and for me it's no, and maybe for some of you it's no, then you accept that there's a value to financial privacy. So the next question is, does that become valueless if your financial privacy takes place through an LLC? And we have to think, as we're thinking about that, let's remember when the World Bank tracks economic development, one of the top things they track is how long does it take to form a business. And we're talking about here under this, as wasn't mentioned during the speech, but what we're talking about here is a requirement to file with FinCEN at the same time that you file with the State Secretary of State. And if you get it wrong, you fail to knowingly file, you're looking at 3 years in jail. So let me describe the very real prospect here that, let's say I inherit a interest in an LLC, stock in an LLC from my dad's small lawnmower business. And this only affects small business, right? Business with fewer than 20 employees. I inherit it, and the lawyer says, hey, don't forget to file this form with FinCEN. And I say, yeah, stupid form. Maybe I should have filed it. I could be looking at 3 years in jail just for failure to file a form if I knowingly failed to file that form. That's an incredible trade-off between financial privacy and anti-terrorism and criminal investigations. And I would add to this, let's also think about the benefit side of that equation, which is, as state law exists now, when you create an LLC, you have to provide the state with information about a registered agent for service of process. And you have to provide your registered agent for service of process with your information, your contact information, your name and your address. Will the terrorist financier, who right now whose law enforcement's hitting a wall when they go to the registered agent for service of process and the agent says, here's the address, and they say, oh, that's bogus. Will the terrorist financier file the same bogus information on the form they send to FinCEN that they currently give to the registered agent for service of process? I think that they will. So I think the costs are higher than have been described, the benefits are lower than have been described, and in an effort to add to the thinking rather than just being critical, I think Representative French Hill has offered a compromise using the regular IRS reporting regime, that if you're an LLC that has income, go through the IRS reporting system. It's already going to have Schedule C, it's already going to have a lot of information. You add to it, and if there are issues about very carefully controlling access for anti-terrorism investigations to the IRS database, you can do that along the way as you're reforming the system in that way.
So I could just say the IRS will have up-to-date information from 1973 next year. I mean, it's very slow, but let me ask you a different question. Would you support anonymous personal bank companies, bank accounts?
Anonymous personal bank accounts.
Would you support that?
I think it's something worth talking about, sure. Yeah.
Would anybody?
I mean, but what do you mean by anonymous bank
I mean, I can walk up and just say, here's some money, give me, I'll set up a PIN and a number, and you don't take any information from me, but give me a debit card.
I think as we move toward fintechs challenging the existing system, I think we'll have to think about the nature of identity, and particularly the nature of business identity, which can be quite complicated. And another angle to this, a complication that I think is not sufficiently appreciated by the proponents of this bill is, when I teach beneficial ownership to my corporate law class, we take 3 days to study it because it's that complicated. It's easy when you're a sole member owner, but when you're a creditor who takes a secured interest that involves preferred stock, or when you're an entity that owns through an entity, it gets very complicated. And when you're thinking about that academically, it's fun. When you're thinking about it against a 3-year prison sentence, it's an incredible compliance cost.
So I want to turn to digital identity in a second because we have one of the world's experts on digital identity with Karen. But before we kind of move down that path, I want to go into an idea that Rajan's talked about a lot, which I think broadening the conversation beyond just beneficial ownership. There's a whole question about the purpose of the AML regime, which this event is focused on, which I think is about catching bad guys and protecting us and catching bad guys before they act. And the current regime is much more focused on individuals and institutions, and technology has evolved in a way in which most people interact with a wide number of financial institutions, and the sum of the data collected across financial institutions for the purpose of getting bad guys hold aside trade-offs in that are far greater. You wrote kind of a groundbreaking article in the Journal of Banking Perspectives years ago, and I think have influenced this debate greatly, where you were kind of the first person out there calling for this idea of a utility of the major financial institutions in enforcing AML. Years later, the bank regulators have started moving in the direction that you first proposed with some guidance to allow this. Do you think the regulators have done enough to allow this utility to form? Does the government need to do more to encourage its formation?
Well, let me begin by echoing what Juan said, and thank you, Aaron, so much for putting this together. As Aaron indicated, I am rather passionate about this issue, and today, of all days, is an appropriate day to consider whether we really need to make a fundamental change in our AML system, and as Aaron indicated, to move to utility model. Just a little background before I get to the direct answer. We have remained mired for now 50 years in what is basically a siloed approach to AML. Every institution creates its own database of information. Every institution conducts its own KYC. Every institution does its own monitoring of transactions, and every institution makes its own determinations about SAR filings. Sharing is modest at best. This is not merely an inefficient system. Much more importantly, it is just ineffective. The proposition is simple. Financial institutions are being asked to make all these AML decisions with woefully incomplete information because they only know what is right before them. They don't know what any other institution has. And as sophisticated as the algorithms may be today, which larger institutions and maybe smaller institutions are employing, they are inherently less than satisfactory because they just can't be trained on enough data to really produce the answer. And we're not just talking about catching the bad guys, although that's the fundamental point. there's sort of an indirect aspect too. We're creating a plethora of false positives which detract from the ability of law enforcement, FinCEN, other government agencies to catch the bad guys because these false positives clog the system. So the answer, in my view, is to eliminate the silo approach, have more and more informed, better informed decisions, and that is the answer. So to your, now, sorry with the lengthy introduction, but to turn directly to the question, if we're going to get there, this has got to be the responsibility of both the private sector and the public sector. The public sector is not going to embrace this unless the private sector not merely verbalizes its interest, but is willing to demonstrate a commitment, time, and resources through concrete action steps. From the public sector's perspective, as Aaron indicated, we're seeing some encouraging indications. But it's got to be more than just verbalized support. For this to work, the public sector has to be willing to say that the ultimate objective is not merely to supplement the current silo system, but the idea of utility is to replace it. And there may be, and probably are, some necessary legal opinions which will be required along the way. This sounds enormously ambitious, but there is precedent for this cooperative approach between the public and private sectors to resolving significant defects in AML and sanctions compliance. And that was the work done a number of years ago to deal with cover payments, which was a whole huge loophole in our AML and sanctions system. Public sector, private sector got together. There was the will then, and if we have that same will now, we'll have a way on a much larger scale.
I guess I would just jump on board Rajan's proposal. I think it's an excellent one. I read your paper and apologize, I did not have a chance to review it before this panel, so it's been a while and I don't remember all the details. One thing that I do recall thinking about at the time is just the privacy and security issues that are raised by creating a centralized repository of information about people, and that would have to be something that would be taken very seriously. You know, since your paper came out, we had the Equifax hack and sort of, you know, have the dangers of creating big repositories of information are probably even more obvious to everyone than they were at the time. So, I mean, I don't think that's an insurmountable problem, but I do think it's important in getting together the right people who can address those kinds of challenges.
Yeah. I couldn't agree more, and I think what's interesting is, we talked about it a little bit before the panel, technology is allowing sort of the intellectual aperture to open, the imagination to think through how do you combine the questions and concerns around privacy with the ability to actually discover risk that we care about. And you know, I'm a huge proponent of this utility idea. We're actually running a pilot with the Bank Policy Institute and a couple of banks to prove that you can do this with all of the privacy safeguards in mind, but can discover things that you wouldn't otherwise discover in the current model, right? And I think it's important to underscore, especially today and with this audience, and it goes a little bit to, you know, why are we doing this, right? One of the major shifts post 9/11 was to say, not only do we want to catch bad guys, not only do we want to prevent terrorists from attacking us and preventing them from having access to capital, but we actually want there to be protection of the financial system from financial crime risk writ large. That became not only the policy mantra, but that became the driving feature of all of the reforms, the regulations, the impetus for what we've seen. And so it's not just how do we create a system that allows us to chase the next bad guy in a more efficient way or in a quicker way. It's actually how does the system itself driven by the private sector largely, manage the risk from this financial crime set of vulnerabilities? And how do we actually prevent these activities from happening to begin with, or if they do happen, discovering them at a higher level more quickly in a more effective way? It's the question of why aren't we discovering the major corruption scandals, the major drug money laundering cases? I call this the $10 billion problem. You have these major organizations that are very savvy at how to work around the rules. And at the end of the day, they're able to launder money. So the purpose of the system is not to catch the corner drug trafficker. It's to try to actually capture the networks that need access to capital to do things that matter systemically and that are dangerous from a national security perspective. That, I think, it's been a major policy shift, and the challenge and the tension that we often talk about is related to the fact that the design of the system, which, as Aaron, you described, was built in the 60s, 70s, and 80s, and even 90s, is an analog system that isn't designed to do what we're asking it to do. And so this utility idea or other variations of how we use data, how we use machine learning, how we think about hashing information so you don't have PII floating all over the place, all of that is part of this debate about how do we get more effective at actually discovering systemically relevant financial crime and sanctions risk.
So the one thing I'll contribute to that is the fundamental design architecture of AML is a sort of a push-up system. But I think one of the things we've learned in securities fraud, a lesson securities fraud can teach AML, is that whistleblowers can be great resources. Enron was effectively caught by short sellers before anybody paid attention to it. The short sellers were on it. Harry Markopoulos was, nobody at the SEC wanted to pay him any attention, but he was right in so many ways. He was brilliant. And the SEC has now moved, post-Dodd-Frank, towards something that I say most of the time, I'm probably a critic of Dodd-Frank, but I support, generally speaking, the notion of whistleblowers. And I think a bounty-type system for AML, why aren't we talking more about that, where it's sort of, maybe you're like a compliance officer at a bank and you see something fishy and your higher-ups are like, no, that's a big client, we can't do anything. And you think, it might be a big payoff if I just go ahead and file it myself. I think that's something that should be on the agenda and part of this discussion. As an economist, you respond to incentives, whistleblowers respond to incentives. Let's add an incentive component to AML. You get better filings that would have more interesting content. You develop a bar around a specialty in the banking law bar around AML bounty-seeking filers. I don't know. Could be a way to help.
P10-like actions.
Yeah, why not?
It's intriguing. You mentioned the purpose of the system.
Yeah.
And there's this balance between protecting the system from people with financial crimes accessing it, and this balance with the desire to allow people to access the financial system because the vast majority of us are here to do law-abiding system, and you're just as likely to be born law-abiding if your name is Aaron Klein or Akbar or Mohammed, or there's lots of different pieces of information that disclose. There's also huge cost burdens, as the Congresswoman alluded to, in putting in this compliance that are fixed costs that are spread upon marginal users. Karen, you and I co-authored this paper with the University of Michigan's now Dean of the Ford School, Michael Barr, and we argued the U.S. was lagging in adopting new technology in financial services, in part because of AML restrictions, and simultaneously not allowing financial services company to adopt new technology to enhance AML efficiencies. Mm-hmm. In the paper, I'll quote it, we said, policymakers globally devoted 2 years to two goals: improving access and combating anti-money laundering and terrorism. We made some inroads in each, but we've also designed systems that actually work at cross purposes occasionally. We concluded, quote, progress remains unacceptably slow, end quote, 2 years ago. Do you think that's still the case? Has anything changed?
I think there's certainly been, things are certainly happening, but to say progress remains unacceptably slow, I think is just sadly true. We wrote that paper because we were so excited about the potential for technology. We really, I still feel this way, that the technology exists today that could vastly lower the cost of provision of financial services, that could improve anti-money laundering efforts, and that could better protect people's privacy and security. That's there today, and it's really not being fully embraced, and it's hard to see how it will be without some kind of broader policy vision that's articulated in a way that industry can rely on. Industry really wants, some kind of certainty. They want to be able to make business decisions and build things out. And without the public sector saying, like, this is where we're going, starting to set standards, saying what the regulatory framework could look like, they're not going to invest, large resources in something. So, and Rajan was making the point earlier that there needs to be a public-private effort, and if there was to be a utility that did AML, I think more broadly than that, there could be a public-private effort to really upgrade the technological framework that we build financial services on. And, without that happening, I think progress is going to continue to remain really, really slow. I was thinking about the whole, the debacle Facebook had with their planned currency. And, there's so many criticisms you could make about how they went about it and what they did, but, they were trying to create a payment system. They're a U.S. company trying to make a payment system, and they did it outside the U.S. And I just feel like that is such a terrible thing. A U.S. company working on payments should be doing it in the U.S., should be doing it with the benefit of understanding what the rules are and getting guidance from policymakers. And just, I think the dialogue has broken down so much that we just, it's hard to look on that as anything other than an embarrassment for everyone involved.
I have a slightly,
Sure, yeah.
Karen has great views, and I respect the views, but I have a slightly more optimistic view, because I think I see the Facebook announcement as a reflection of something broader happening, which is new technology trying to capture not only business, but payment rails and networks that are being either absented or not fully developed by the formal financial system, right? And so with our clients, we see not only are there new technology firms and a lot of social media companies that are trying to use their databases, their platforms, their networks to then establish a payment network, like the Facebook Libra announcement. But also you're seeing technology companies begin to blend with existing formal financial system actors like medium and smaller banks to try to capture, for example, the unbanked, because they not only see there's a business opportunity, but the technology and the cultural awareness around compliance is allowing a sensibility around the management of that risk, which is to say, 10, 15 years ago, you say, look, it's perhaps dangerous or risky to bank remittances from Minnesota Somali Americans into East Africa if you don't know if it's going to Al-Shabaab's hands, some pirates' hands, or what's going to happen. There are those that are trying to enter those kinds of payment channels and markets precisely because technology is allowing them to manage the data better, but also they're thinking more creatively about how do you actually manage the risk. And so I think there are still major challenges, but I think the technology firms as well as entrants at the small and medium size are willing to take a bit more risk for both the business opportunity and given the ability to manage the risk in a more effective way.
Well, if we can't have a conversation with the payment system without me jumping on the point of real-time payments, I'll say 7% of Americans are unbanked. 3 times as many are underbanked.
Yeah.
The definition of underbanked is I've used a check casher, a payday lender, or a wire transmitter to move money.
Yeah.
And it's because our existing payment system sucks. It is a technical term, and it is a joke compared to the fact that the rest of the world adopted real-time payments sometime between 5 and 25 years ago. In fact, the private sector and the banking sector deserve some credit for adopting real-time payments technology, absent a regulatory mandate that our central bank has refused to give despite having the legal authority to since 1987 under the Expedited Funds Availability Act. Had the Federal Reserve given that legal mandate when the Bank of England adopted real-time payments in 2007, I think $200 billion would have been saved by low-income individuals living paycheck to paycheck that instead went to bank overdraft fees, payday lenders, and check cashers, and pawn shops. Those are the winners, with our payment system being a loser. And now, rather than use that regulatory authority, the Fed has announced that sometime in the next decade, maybe, they'll adopt a new payment system and new technology with the kind of, this is the opposite of the goal that you're describing, which is regulators putting clear guidelines out and the private sector adopting. This is the private sector adopting and regulators moving the goalpost. But sorry, that's, I need to be a moderator, not a position person here. Real-time payments gets me going.
Can I insert, we agree about 85%, but I diverge at the point of, I think the way to get there is the Fed is not very efficient at running a payment system, and it's terrible at managing conflicts of interest in its role as a provider of payments and a regulator of its competitor private sector system and a regulator of the clients of both. It's terrible at managing those conflicts. Get the Fed out of the business altogether, and I think that crowding out, if you eliminate that crowding out, you get more of what you want to the private sector. But
it's a fair point. Let me turn to another piece of technology that didn't exist 18 years ago. Virtual currency. When we were discussing the Patriot Act and AML, virtual currency wasn't a thing. Today, virtual currency exists globally, is used for a variety of purposes, licit and illicit. Do our existing AML rules make sense for virtual currency? You referenced the kind of Libra idea, but there are lots of other virtual currencies that went out there without a big public rollout and asking for public feedback. They just went live. Do they make sense? If not, should they be changed? Rajan, what do you think?
Well, I think we clearly need to do a lot more on the AML for virtual currencies. And it's not just a question of what the rules are and how they apply. It's who enforces them. The idea that you would have a large part of the payment system that could move money, which is self-policing, that just means ultimately you deteriorate to the bottom. I think, the virtual currencies and the technology behind it actually give the promise of really being able to develop the type of technological approach to AML that Karen was quite correctly referring to. So I don't think we have it down correctly yet, and we have got to make sure that the virtual currencies or Libra, if it does get off the ground, is subject to not the same, but with the same effect, KYC rules, filings of SARs, every aspect of KYC, and that there is an appropriate enforcement mechanism. And I continue to worry about that, because if we don't get this right, virtual currencies have the opportunity to blow a total hole in our AML system. As effective as it may be even today, it will become largely meaningless.
Are we at that big of a risk?
Everybody says, oh, they're tiny compared to fiat currencies. But we're going to wake up one day, in all probability, where virtual currencies or some form are going to be a real challenge to fiat currency. And then it's going to be too late to try and regulate it. It will have gotten too large, too global, and it will not be subject to regulation.
I can't wait. I would take the opposite perspective. I think it'd be a great disciplining mechanism for the budgetary discipline that's just not present, and the support for budgetary excess that the central banks have always provided over the history of the Federal Reserve, despite their rhetoric to the contrary. And the other thing that often, I think it took some time to educate the folks at Treasury and the state AGs, but I think they've gotten there. I think they get it. They're sophisticated now, but when I first started House Financial Services, trying to work with them in 2013, 2012, they didn't understand that one of the fundamental promises of at least Bitcoin, as an example of crypto, is that unlike cash, if you have that sort of NYPD Blue moment where you pressure someone and they give you their code, then you have an open source history of everything they've ever done that cash does not provide. And you could see the minds of people flip like, wait, really? Oh, wow, that's very interesting. So there's a lot of promise actually for interdiction of very bad things once you sort of tap into the code just by the nature of the mechanism itself. So.
Can I piggyback off that? In full disclosure, I've been an advisor to Coinbase for a number of years, which is the big crypto exchange operator based in San Francisco. So I've watched the evolution both from the outside and the inside. And I think what's fascinating is that we've reached this moment where there's a recognition that there's hope and promise in the technologies. There's the ability to think of these technologies as a way of providing new payment services to enable peer-to-peer transactions, to bring people into the system, even to think about traceability. You have, Treasury authorities using technology that allows them to trace, digital identities using the public ledger. So it does become a real asset for law enforcement and regulators. At the same time, a recognition that bad guys have figured out how to use this, obviously, right? So it's a money laundering problem. We all know that ransomware is paid out in Bitcoin. We know that terrorist groups are beginning to flirt a bit with these accounts. We've seen this with Hamas. We've seen this with others. So we know the bad guys are accessing value and capital. And we've seen North Korea with their cyber attacks, according to the most recent UN panel of expert report, profit over $2 billion worth based on their cyber activities and heists, much of which has happened in the crypto context, either attacking crypto exchanges and stealing the money, or just using crypto as a way of transacting. So there's a real problem there. And systemically, there's a challenge of thinking about those organizations that are isolated, or those regimes even that are isolated, like the Venezuelan regime, for example, and the Russian regime, beginning to connect their networks and their systems, something what we've called alliance of crypto rogues, and beginning to tie their networks together. So that's a real challenge for the sanctions regime and others. But the final point is the promise here is you have even Mark Carney. I know we've got some British colleagues in the audience. Mark Carney gave a speech at the end of August, which I think was a bombshell, where he talked about the central bank governors coming up with a new reserve currency that is crypto-based, and that the major central banks sort of coordinate and invest in. And it goes to this evolution where initially there was a complete rejection of the technology, and now you have the central bank governors around the world thinking about how to use this, with, by the way, the regulators trying to figure out how do you ensure traceability, transparency that's inherent in the money laundering system.
So you mentioned cyber crimes. I mean, NotPetya is another one where you're starting to blend the line here a little bit between terrorism, criminals, and governments.
Yep.
Is our AML regime set up, and sanctions set up to handle cyber war by nation states? I mean, is that something we want to tack on here?
I think it has to be part of the broader national security discussion. I don't think you put the full weight of that on the AML system. I think at that point, the system begins to rupture and you're asking too much of it, in a sense. But it is part of a broader question about, are we defending the system properly? Do we know who's in the system, and how are they accessing capital, whether it's through the formal financial system, new payment systems, or crypto? That's part of a broader national economic security debate, which is upon us. I think the big challenge there, Aaron, is the fact that you have nation states now involved. So you're not just dealing with Chapo Guzman and the Mexican cartels or Russian organized crime, but you have nation states, rogue states, mafia states that are willing and able to access the financial system, misuse it, use cyber capabilities to profit, and then to hide it. We know the Bank of Bangladesh case, the heist, came from the North Koreans. If it hadn't been for a typo that the Fed caught, it would have been more than the 81 million that North Korea was able to exfiltrate through the SWIFT payment system back through the Bank of Bangladesh, through casinos in the Philippines and back into North Korean hands. So I think to the extent that you have nation-state actors blending with non-state networks using the financial system, that's a huge problem, and it requires a whole set of other tools and strategies in addition to the AML system.
I don't know what NSA does or how they do it, and I don't want to know, and I shouldn't know. And actually, that's part of the problem, is we've learned a little bit too much about what they do. This whole conversation would be a lot easier if we didn't live in a world where we all know, that an Army private got a hold of sensitive diplomatic cables and shared them with the world through WikiLeaks. The Federal Reserve has been hacked. Thankfully, I don't think FinCEN's been hacked, but who knows, right?
The greatest hack that ever happened to me was the Office of Personnel Management.
Yeah.
Right.
Where the Chinese took my security clearance. So, this kind of gets this question
And
about...
my fingerprints.
Let me go to another topic that didn't exist 18 years ago in the way it does today, which is state-licensed cannabis. It was brought up earlier. Today, 46 states allow for some form of medical cannabis. 1 in 5 Americans live in a state where marijuana is available for sale in commercial storefronts for recreational use. Banks and regulators are faced with a situation on what to do for something no one ever dreamed of. Businesses operating with state government approval for drugs that remain federally illegal. How do you think AML laws and rules are adopting to this situation, and what do you think should be done about it? I gave a talk this morning before the Las Vegas Chamber of Commerce, and this came up, not just because they're state-licensed cannabis stores, but now if you own real estate, maybe you have a tenant. If you're an architect, maybe you design their facility. If you're running the power company, somebody's trying to pay their power bill in cash. This money infiltrates through the financial system, which is designed never I assume, Juan, in your wildest dreams, did you ever think, or Rajan, as you guys were coming up with some of the laws here, let's design a system where in case 20% of Americans can live in a state that allow pot shops, and how are they going to pay for it? What needs to be done with this?
I just think banks are in an impossible situation where they're being asked to decide which felonies are okay to overlook and which ones aren't. That's just unfair. It's on Congress to move, and it seems like the momentum's there. I don't know if it's there yet, but I think the tipping point is approaching.
I think absolutely right. I think the risk is exactly what you described, Aaron. And we deal with clients that are trying to figure out, okay, do we have to worry about the delivery trucks that are delivering food for the Friday afternoon lunch to these places? And
I hear they get very hungry.
Well, they get very hungry. The Cheetos deliveries are persistent. But the one thing I've worried about, and I said this from the get-go, and our Canadian friend mentioned this earlier, is the fact that the risk tied to drug money laundering just grows more and more complicated. Because if I'm a bad guy, and I said this 4 or 5 years ago, if I'm a bad guy, I'm going to find a way to blend my operations, my network, in through what are considered legal and otherwise legitimate networks in Washington, Colorado, Nevada, wherever they are. And I'm going to make it really hard for authorities, whether in my home country or in the U.S., to figure out where it is that I'm layering and placing my drug proceeds. And so the question posed by our Canadian colleague is a great one, because I don't know what's legitimate or not coming out of Colombia. I don't know what's from the Mexican cartel that's operating in and through the California dispensaries. I don't know. But if I were a drug trafficker, I would set up dispensaries and legal operations and make it really hard to distinguish between legal and illegal. And that's what makes it even harder for the financial system.
Let me take the flip side on that and ask you this, right? If you cut off state licensed entities from access to the banking system, they end up with a bunch of cash.
I'm
a bunch of
I'm
cash-
not even
right, right.
arguing for that.
No, I understand. A bunch of cash creates crime,
Right.
right? It creates security, which is against the will of the local voters who are going with this different approach. In the state of Oregon, they allowed so much cannabis production that the price radically fell to the point where probably you aren't an illicit drug operator because it's no longer profitable in the state of Oregon. In other places where bank access has been made more challenging, it keeps the price of state licensed up, which creates more of an economic opportunity for the very black market people that, now there's a push-pull between law enforcement and the will of the voters in these states. And, I've tried to be very careful in my words. There is no legal cannabis. They're state licensed.
Right.
Well, what I heard
would
once,
just
Karen
like
lives
to
in
say,
California.
Yeah, as somebody who lives in one of these states, I cannot wait for cannabis banking to get organized because it's super dangerous for people to be going around with large amounts of cash. I live in a small town. There was a gunfight in my town, and it makes sense because people are walking around with crazy amounts of cash. If you're a criminal, why not hold people up? So just like, I don't know, 4 example isn't proof, but I do feel that everyone benefits when the proceeds of businesses that have been licensed get into the banking system. All kinds of checks can happen on those businesses that can't happen if they're forced out of the banking system. It just seems like basic common sense.
That's right.
That we come to terms with some of these issues and do it quickly because it's like you're helping criminals when you push money out of the banking system.
I would just totally agree with Karen. And I want to come back, if I can, briefly to JW's point, because he's got to be right. The reason we have a problem is that we have a clash between state legislation and federal legislation. State legislation can't solve that. Only federal legislation can, and that's the way to go.
I would just
Would all of you support the Safe Banking Act?
I have to read it.
Yeah,
but-
exactly.
That doesn't stop a lot of members on the floor.
In
I like to
principle,
read
yes.
what I
Yeah.
support.
But I just learned something, a lot of new things today from one. But one thing I had never thought about was this idea that keeping the pot business cash means it's no longer at the first stage of money laundering that we used to think about. It's actually at the integration stage. Right. It's the legit money you're trying to integrate into. So it's moved to keeping it cash moves it to a different stage of the
It's a crazy situation.
money laundering cycle.
Yeah.
I never thought of that.
And it also disconnects from the price. So, Aaron, your point's right if the motivation is price, but if your motivation is placement and layering, the cartels may not care about price, right? What they want is the ability to hide or to place legitimately, and if they have to take a haircut, it's just the cost of doing business.
So I think you're entirely right, and one more layer on top of it. The seed-to-sale licensing and accounting and all the rest vary state to state.
Yeah.
Because there's no reason to assume that any of these states, as they idiosyncratically go down the line, are using the same legal requirements that the other states are. And so it gets even more confusing.
And not to sort of force a connection back to the Congresswoman's legislation and speech, but it does ultimately come back to ownership and control and beneficial interest here, right? Who owns the operations in California? Who owns the operations in Oregon? We should know that. We should know that.
So I have one more question for the panel before we turn to the audience, which is that, thinking about 20 years or 18 years after 9/11, one of the biggest changes is technology. Moore's Law remains unbroken. The tech companies are coming up with new innovative ways to solve problems that we never thought of before. But somehow in banking, there seems to be a constraint on adopting these new technologies as it relates to AML. We've talked about some of these aspects legally and regulatorily. Karen, you served as a regulator and an executive at a tech firm. Kind of what is the problem? Is the problem technologists failing to adhere to regulation? Or is it regulators failing to keep up with technology?
Oh, I think the politically correct answer to that is that there's fault on both sides, and I really used to feel that way strongly. But, at this point, I'm going to say this technology has been out for a long time, and technologists have been, around, and regulators have gotten a chance to get to know them. And, I feel like at this point, it's a little bit on regulators to move. They, technologists can sound very combative. At least there's a part of the technology community that can be very oppositional when they talk about regulation. But I just really want to, I would ask regulators to ask themselves, are those people really more problematic than bankers? Bankers wear suits and they sound nice and they don't talk about disruption, but there's plenty of very difficult personalities in that group as well. And the job of the regulatory community is to deal with people, and nobody's an angel, nobody's a devil. And I think just sort of moving forward in that direction is really on the regulatory and policy community. I would also say that what I've noticed in the regulatory community a little bit is just like insecurity or fear about learning all this new technology and how it works. And again, I would say regulators already work, if they're financial regulators, they're already working in a world of a lot of technology. They're working in a world of very complex financial instruments, and they have found a way forward. They have found a way to deal with that. And this is just one new set of products and one new set of technologies, and they can deal with it. It's not too hard. So, that's where my thinking is right now.
So people in hoodies and people in suits.
Don't worry about the hoodies.
Go, Roger.
Just one quick point. Since you raised RTP, actually, I think this has
real-time payments.
A relevance to AML, which is if you would have it, the information field could actually be quite useful to detecting patterns and would be helpful. And since you raised it, just one more second. If we don't get movement on RTP, who's really going to be disadvantaged are the small banks, even though they are advocating strongly for the Fed to come in. What the Fed has said is, we want to come in, but 5 years from now, that's not going to be right for the small banks because you're going to have in every town where there's a large bank, it can offer its customers RTP and the small banks can't. And this is going to act so much against their interests and against the interest of their customers in rural America.
So I can't, to tell the audience a funny aside story. So earlier today, Roger was speaking before the American,
Institute of Certified Public
Institute of Public Accountants. And you want to talk about an industry that opposed something in their own interest. I work for Senator Paul Sarbanes. And you mentioned, I think, Enron. I'm going to the old Enron field for a baseball game tomorrow. But as you guys know, Enron may have had a little bit of a problem. And as a result, Congress may have passed a small accounting reform known as Sarbanes-Oxley. I remember the first group to come in and oppose it was the public accountants. Do you know what industry made the most money off of Sarbanes-Oxley? In fact, it was their single largest source of revenue growth was the legislation they fought tooth and nail. So it's kind of funny how sometimes industry can oppose one thing that turns out to be in their best interest because perhaps bank overdraft fees may be a thing of the past in a few years, but there may be new technology layered over that allows a whole new system to open up. But I think I promised some questions. Micah?
Thanks, Aaron. Micah Green with Steptoe and Johnson. I guess a question for Rajan. With all the various silos of reporting entities and all the various regulators, and I know there's international efforts through FATF to try to create comedy around the world, how do you see a utility structure working not only within the United States but across the globe?
No. And it's a very fair question, and it's a bit of walking before you can run. So I think we've got to be able to get it done in the U.S. The real problem globally is going to be privacy and the ability to provide that information into the United States. And if I could create the world, I think the U.S. and U.K. are closest on that. And if we could get an agreement ultimately between the two, then it would move into Europe and elsewhere. But that's a problem which I'm not sure is going to be readily soluble.
Aaron, can I just supplement that? I think what's interesting here is the utility model and other variations of kind of the next evolution of the AML system will likely emerge in other jurisdictions before the U.S., in part because I think the regulators, as Karen was mentioning, are a bit sort of a step behind. Not because they're not smart, not because they're not willing to understand, but it's a more ossified system. Whereas if you look at Singapore, for example, Singapore is trying to compete and become the financial center in East Asia and Southeast Asia, obviously, competing with Hong Kong and others. They're looking aggressively to how they can innovate. And they've, in fact, been doing a number of pilots, in fact, funding pilots in this regard. I think the same will go for Dubai. I think other banking centers will begin to outpace some of the innovation. I agree with Raj. Ideally, you'd have the US, UK doing this. In fact, I think the UK is going to be ahead of us. And it's largely going to be the private sector, I think, that drives it here first before the regulators and law enforcement gets on board.
I would just also like to say the point that you make about the discontinuity between England and the US versus Europe with respect to privacy, that's really an issue that technology could go a long way to resolving. There would be ways to keep private, personal information private, or housed in, servers in Europe that would resolve a lot of the European issues. Yeah.
But we can't forget, though, that the naughty kid in class in this, with tax treaties, with these kind of treaties, is China. This is a country that has components that make systematic efforts to steal intellectual property, and that can use information about LLCs, about tax issues to piece together things that can help state-owned firms. That's an issue that's unavoidable, I think, as you build this out. And it's similar to one of the issues I have with the beneficial ownership bill, which would give state AGs access. And sometimes, political state AGs go on fishing expeditions against private companies. I mean, it happens. It happens.
Thank you. My name is Gayet and I'm from the IMF. I wanted to ask, first of all, I wanted to note that financial institutions do share data between themselves on other type of threats, such as cyber threats. So you can look at the models in this realm and perhaps copy it to AML-CFT. But I have a different question. Basically, a few of the members of the panel said that they want to keep legitimate transactions in the system and keep illegitimate transactions out of the system. And this is a separating equilibrium, which could be very different from sector to sector and from state to state and according to the location of the financial institution in the network. And you ought to get it wrong. So one is, do you prefer type 1 of mistakes, that having bad transactions in the system, or type 2 of mistakes of excluding good customers from the system, and whether the rules should be more flexible to allow each institution or each sector to fine-tune the parameters of AML-CFT inspections to get this separating equilibrium right?
This is a really interesting and important question because I think it goes to the heart. I like the way you asked it. It goes to the heart of how we think about risk management in the AML space. And one of the challenges I think that the financial institutions will say is, look, the policymakers, the regulators all talk about putting the onus on us to risk rate and to modulate, but at the end of the day, it feels like a zero tolerance sort of mentality. And so there really isn't risk management in the AML space. When we talk about sort of the evolution, we talk about sort of track 1, the current system, moving to track 2, a more innovative model. A core question is, how much can we live with false negatives, right? What rate of the false positives has to drop? Those are questions that the regulators are grappling with as we speak. And it goes right to the heart of your question. How much will institutions be allowed to rheostat their risk management around financial crime risk. And if we can, for example, reduce false positives by 50%, because most of the false positive rates in the current system are above 98%. Imagine that. If you drop it, let's say 50%, and you've got maybe a rate of 3 or 4% false negative, is that good? It sounds pretty good, but I don't know, right? And the regulators are debating that as we speak and trying to figure out what markers do we use to validate what a good risk management system looks like with these new technologies. So we're right in the middle of the debate. There's no answer to it yet, but you've asked the right question.
I would also add that it could be a little bit, how can I put it? Like the way banks ask this question is not, it's narrow to their institution, right? So if they're willing to tolerate, a lot of false negatives and push people out of their bank, then they look better to their regulators and feel safer. But, is society safer with a lot of people pushed out of the legitimate banking system? It gives cover to, bad actors if they can just blend in with ordinary people who can't get access to the banking system. So it also matters from what perspective are you asking that question?
All right, in the back.
Thank you for Brookings having this informative event. I'm Jun Soo-kwon from the Heritage Foundation. I want to ask you panelists that if there is any international law or interactive cooperation with other countries that can foster this AML movement or accelerate this anti-laundering policy.
Sure. One of the interesting things about this field and space is there is an international regime, largely driven by the Financial Action Task Force, which sets the international norms and practices and then assesses countries now in the fourth round of assessment around the effectiveness of their regimes. And there's not only the FATF body, but regional style bodies that lay out the recommendations and the technical requirements. In fact, FATF just this past summer laid out in an interpretive note, which is a kind of a term of art of kind of an advisory, how to think about the regulation of digital and crypto assets, right? And that now is driving how the international community is debating this. So there's that system. You also have the Egmont group of financial intelligence units around the world, which are at least purportedly created to share that kind of information within their governments, but also with counterparty FIUs, and there are special agreements to that effect. And then there's all sorts of sharing between institutions, as was referred to earlier. In the U.S., there's legislation 314A and B of the Patriot Act that allows for sharing between institutions and more aggressive sharing with authorities and the private sector. And so there are different models of that around the world. But to answer your question simply, absolutely, there's an entire regime built around trying to not only have the same norms and principles, but to accelerate the kind of information that's shared. A lot of that's being restricted now by data privacy and data nationalization, and there's a little bit of tension in that regard.
So for some good recommendations to FATF, I would commend the Gifford Bar Klein paper, which tried to answer some of your questions about type 1 and type 2 errors. I think it's safe to say we lean a little more on the inclusion side. As we close, I want to kind of sum up and give each of you the opportunity, because the Brookings stage is a magical place. And so I'm going to give you each a magic wand, and you're able to make one legislative change to our AML laws and one regulatory change. Tell the audience what you would change, what it would result in, and why you would prioritize that. Jadoli, should we start over there and bring it to a close?
All right. Do I have to say Harry Potter magic words while I do it?
Yes, you do.
I would do a couple of things. I would include, in addition to the reporting regime, part of what makes this regime what it is the related criminal regime. I would apply, there's been an effort in the past to apply to the criminal law generally more of a scienter reform, so to make scienter the default unless there's some reason not to make affirmative scienter the component of a criminal action. I would apply that to beneficial ownership reporting if it passes over my objection or my suggestion of working with Representative Hill toward compromise. I would look to redesigning the system to provide incentives for people, bounties. If you can stop the next 9/11, or even if you can help catch a tax fraud or a drug dealer or intermediary for them, there's a bounty in place, a generous bounty system in place for you. And beyond that, I would apply my magic wand to securities law if you have a list. But that's for the next event you invite me to.
Aaron, I'll be quick about this. I would say reform of the Bank Secrecy Act that does two things. One, reinforces the idea that this is no longer just about following the money to catch the bad guy to help law enforcement, but fundamentally about protection of the financial system. That's what we say from a policy perspective. That's not what's legally required pursuant to the Bank Secrecy Act. What that does is it liberates then the animal spirits to have within that same legislation the ability to say, we are going to allow the financial sector and those regulated entities to figure out how best to manage the risk around all of these risks that we're worried about, but you figure out how to do it. And the SAR system is a part of it, but it's not the only part of it, and it's not a cornerstone. On the regulatory complement to that would be the regulators would then provide a safe haven to those institutions that are experimenting with non-SAR-like systems, using behavioral analysis, for example, instead of rule-based systems, to say, look, if you discover things in your system that your old system didn't capture, we're not going to hold you to account. They kind of have said that, but there is no legal safe harbor. And so what you have are institutions very much unwilling to say, oh yeah, we're going to be experimental, we're going to go find things. But the problem is it's going to reveal things we should have been doing, and our regulators are going to ding us for it, we're going to get in trouble, and I could lose my job. If we're going to innovate, we're going to move to track 2. There has to be some degree of safe harbor or allowance.
Wow. Both super interesting. I guess if I had Harry Potter magic words, it's hard to choose. But I think what I would do is ask Congress to pass a law that would enable portable digital identity, and regulatory effort to maybe partner with the private sector to come up with a regime of regulations that would get personal information out of the hands of all the many, many different companies that are trying to manage it now, and into a more secure format where it can be managed mostly by the individual who owns it. And that would also give, obviously, law enforcement access to personal information when necessary, but maybe have far greater access to information relating to patterns and odd behavior, troublesome behavior that is very hard to track right now.
So let me start with my Harry Potter magic word, which is the only word I know where the two clauses in the single word are oxymoronic, and that's bipartisan. That's what we really do need to be able to do it. The legislation and regulation both come from the same source, and it's what Juan mentioned earlier. It's sections 314A and B of the Patriot Act. With respect to legislation, I'd like to see A expanded to permit sharing with foreign governmental authorities if approved by whoever we want to have approve it, and on a reciprocal basis. For 314B, for the regulatory authorities to make clear that the application of technology to data does not somehow mean sharing of data until a suspicion is formed.
Wow. Well, join me in thanking the panel for their time today.
Aaron,
And
thank you
appreciate everybody.
for doing this.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.